Friends, in this video for I Thought Wealth, I'm going to talk to you on a very contentious topic, distribution versus RIA models. There are two models in the market for fund advisory, and there is a very polarized debate as to which model is superior. As somebody who has seen this from the inside, I have a few observations to make, and then I would go into the merits of the two models. Firstly, whether a person is a distributor or an advisor, the fiduciary requirement is the same. One cannot have a different fiduciary standard for the two activities because the product is almost the same and the customer is the same and the need is the same. When the product, the customer and the need are all the same, you need to maintain the same standard of fiduciary levels. You need to maintain fiduciary excellence. So that is something which is non-negotiable. Now let us come to the two models. The distribution model essentially is meant for investors who are beginning, who need hand-holding and who want to gradually scale up their portfolio with that hand-holding. What is this hand-holding going to give them? Because today there is an obsession not to pay anything to anybody. But the price of hand-holding is quite sensible, and that hand-holding can help you in a very clear manner. How can hand-holding help you? Hand-holding can help you by not taking you into products which you should not buy, by restricting the product universe from which you must make your choices, by helping you avoid the high risk products which don't suit your risk profile, and by ensuring that when you're doing very well and when the markets are overvalued, you take some money away and keep it safely to be reinvested when the markets fall. Now these are things which should be done for an investor in his early years, especially in his first and second market cycle. If somebody does this correctly for a person, chances are that person will capture the benefits of investing in a class like equity and getting those benefits in his portfolio. Now, can this be done only with the distributor? No. You could do it if you have a very good mentor. You could do it if you have a very successful and very balanced peer, somebody who could guide you and do everything that the distributor does for you. But the person whom you are relying upon must have the time and commitment to do it for you. It should not be that you are just going to get a little bit of advice, a whiff of idea here, something there, and then you are trying to piece it together with your own perceptions. It can't be like that. It has to be a commitment. Whether you are going to do it on your own with support of peers, or if you are going it with a distributor, you need to ensure that commitment and fiduciary alignment is there. Unless you have those two things, chances are you will be driven by performance and make mistakes when the market turns or at the peak of a market cycle. That is something which somebody must avoid in his first two market cycles. So in that sense, a distributor could be of help to you if he is providing you the highest fiduciary standard, if he is placing before you products which suit your risk profile, if he is helping you go towards safety when markets are overvalued, and if he has your interest and his interest perfectly aligned. That is something which you need to judge. Now to the RIA. The RIA as an idea is built on the premise that if you pay the fees directly to an advisor, he is more accountable to you. Fundamentally, it is coming from the belief that a product distributor is not going to be providing you the same fiduciary standard. While I may have my differences with this viewpoint, let's just accept it and then move on. I believe that an advisor's interest alignment with you should also be a continuous commitment. While an advisor can maintain full commitment at the time of giving an advice, he also must be with you in a fiduciary arrangement or a relationship where he maintains that fiduciary levels right through your investment experience. Now, this is something which has not adequately got built into advisory mechanisms, because there is a belief, and you will get that belief even when you read the regulation, that advice can be one time. So, in the kind of world that we live in, you require advice on a dynamic basis. And it has been so right through my personal investment experience. So, I have always relied on advice of so many people, and I have trusted them. I have developed the fiduciary comfort with that person, and I have maintained the relationship with that person so that they guide me in my evolution and growth. So, unless somebody did this to me with the kind of fiduciary equation and role play, I would not have grown as an investor. So, that is something which is a must, and it is very, very critical to have continuity in that fiduciary delivery. So, you cannot have it truncated, you cannot have it one time. So, if you are seeking an advisor on the belief that because you pay him, his interest is aligned with you, you need to have a continuous engagement with that person, and it cannot be a one-time engagement. I'll give you an example. Let's say you got an advice from somebody in January of 2020, and then you started investing. Let's say you have COVID in between. Can you continue with the same advice that you received in January right through? No, you may need to revisit. You may need to either become more aggressive or more conservative depending upon your risk profile, the financial situation, the market situation, your levels of liquidity, when you need that money for your future financial goals, and why you are investing for, and what your investing is going to lead you towards. So, all these things have to come into that equation. They need to be reviewed like it's an emergency, and then some adaptive stances may need to be taken. Only then you will be able to stave off risks, take advantage of opportunities, and keep moving the course on your investment journey. So, continuity of fiduciary relationships is very critical for advisory relationships to survive and to give you value. The fact that you pay the advisor alone is not sufficient. And the second thing which I have noticed even in advisory relationships is people who have traditionally moved only with distributors come into advisory relationships with the same mindset. Now, on one side, we always feel the advisors should do better, or we are judging the advisors. But who is to judge the investor? I have seen in several cases investors coming with the same mindset with which they have dealt with their bankers. Even when they come to an advisor, they'll have the same mindset. So, when you deliver an advice also, they will be applying recency excessively to judge the advice. So, they will not show the right traits which a good fiduciary relationship must demonstrate. Now, in that case, despite paying money and despite giving the advisor financial remuneration directly, investors can fail to take advantage of the advice they received. I have also seen this where I have given free advice to friends. For example, I have this strange experience where I told friends to buy an SRF at 30 rupees and it went to 15 rupees at the beginning of this century. The friends got very angry and upset that the stock went down by 50%. But you know the price of SRF today, it's close to 6,000. You know the returns. What happened to their investment behavior? So, whether a person pays the fees or whether he is getting a distributed product or whether he is getting free advice, the problem lies in how fiduciary equations are maintained, how we invest in those relationships. Make sure that your fiduciary aspect is fulfilling and it is strong, and make the effort to build that relationship. Don't have this attitude that you are paying this person or this person is paid by somebody else, therefore he better do his job. It's not like that. If you had that attitude with your lawyer or your chartered accountant or a doctor, imagine how that equation will turn out. If you are going to bring that attitude during that engagement, just think what the other person will feel about giving you that service and how that service will be delivered to you. Maintain the same equation whether you pay the advisor, whether you go to a distributor, or whether you go to even a peer who is giving you free advice. Don't maintain this attitude and don't do things which spoil the fiduciary equation. This is something which is very important for people to build and sustain over long years. And I can tell you from my personal experience that the greatest advice came to me from people to whom I gave immense respect consistently over long years of time. The people to whom I maintained sustainable business relationships over long period of time, whose services I utilized for long years without changing the arrangement. And these things are a reward for maintaining those fiduciary relationships. I believe that the reward is for the fiduciary relationship, and that is the primary driver and not fees or the money we pay people. So bring that attitude and culture into your investing, and whether you choose a distributor or an advisor, if you make your choices based on this aspect, you are bound to do well. You are also free to have your own friends as your advisor, provided that friend is willing to invest in you and is committed to your financial well-being over a long period of time. Thank you for watching this video. I would request you to share this video with your friends who would be interested in understanding this subject, and I request you to stay the journey with iThoughtWealth. Thank you.